Let me be blunt. Some of the advice I see getting passed around right now is not just wrong, it's dangerous. And the people parroting it, they're either too young to have been punched by the real market cycle, or they've never had to explain to their family why their capital's gone. Because here's the truth. Bad advice doesn't hurt right away. It feels good at first. It feels logical. It feels like everyone else is doing. Until it doesn't, until rates spike, until liquidity dries up, until the sponsor ghosts your email, until you're left holding the bag on a deal you never really understood. That's when the pain shows up. And by then, it's too late to go back and think clearly. I'm making this episode because I'm tired of watching smart investors get sucked into simplistic ideas, half-truths dressed like wisdom, aggressive risk framed as entrepreneurial, lack of underwriting disguised as confidence. I've seen it all. And if we don't talk about it publicly, clearly, and with conviction, more capital is going to be burned in the next 12 months than in the last 5 years combined. Let me give you an example. I got sent a deal recently from a sponsor with a big social following. Lots of credibility online, big words, bigger promises. Their pitch deck opened with this: real estate always wins, you have to just hold it long enough. Sounds smart, right? It's the kind of line people clap for. But here's the problem, it's not true. Real estate doesn't always win. Not if you overpay, not if you're overlevered, not if your sponsor can't execute, not if the structure puts the LPs last, and definitely not if the timeline forces you to make a sale in a bad market. But this is exactly what I'm being told from emerging investors right now. Oversimplified narratives with no nuance. Cash flow solves everything. Multifamily is recession proof. Just get in, equity always catches up. None of that is real capital wisdom. That's content marketing. And you shouldn't be risking your legacy on someone else's Instagram strategy. So in this episode, I'm going to walk you through the 3 most dangerous pieces of advice I hear today in the real estate world, and what smart investors, seasoned allocators, are doing instead. We'll talk about why cash flow is king, can blind you from structural risk, why just hold long enough is not a risk strategy, and why the dream of passive income has quietly turned a lot of investors into silent partners in someone else's chaos. I'll also share a story about a deal I almost said yes to, one that all the surface level indicators of safety, and one critical flaw I only caught because of how we think at Infinity 9. And if you stay with me until the end, I'll give you the exact questions I ask whenever I hear a deal that sounds a little too smooth, a little too confident, a little too familiar. This isn't about fear, it's about clarity. Because when you think like a capital allocator, not just like an investor, you stop chasing slogans. You start asking the right questions. And you stop outsourcing your judgment to people who have never earned your trust. Are you ready? Let's get into it. Let's start with one of the most popular mantras in real estate investing. Cash flow is king. You hear it everywhere, in meetups, podcasts, social posts, investor decks. It's the go-to justification for almost every mediocre deal. It's also the most misunderstood concept in the game, because cash flow can be a powerful part of wealth building, but only if it's real, reliable, and strategically structured. And most of the time, it's not. Let me explain. Most investors think cash flow means safety. Hey, I'm getting monthly distributions, so the asset must be working. But in a lot of deals I review, here's what the cash flow actually is. It's a short-term optical illusion paid with long-term risk. I've seen investors and sponsors distribute from reserves. I've seen waterfall structures that pay the LP early while quietly pushing risk downstream. I've even seen debt-fueled distribution where investors get paid from borrowed money. That's not cash flow. That's a confidence theater. Feels great until the music stops. But here's a real example. We were reviewing a multifamily deal last year in a secondary US market. With a good operator, strong rent comps, distribution forecasted started in month 3. But when we ran the underwriting, we saw something that the deck didn't mention. The cash flow was based on the assumption that the property would lease up in 60 days, with rents 12% above market average. and that they were already promising investor distributions before a single lease was signed. Now ask yourself, what happens if lease up takes 90 days? Or if the market doesn't support the pro forma rents? What happens to your cash flow? You're not just delayed, you're exposed. And that's what most investors don't realize. Cash flow is not a guarantee of safety. It's just a function of the assumptions behind the spreadsheet. And if those assumptions are built on ego, hope, or YouTube hype, your so-called safe deal might actually be the most fragile part of your portfolio. So let me be clear. Cash flow isn't king. Discipline is. Discipline in the underwriting. Discipline in the capital structure. Discipline in saying, I'd rather wait for the right deal than force a check into the wrong one just because it pays me monthly. Now, does that mean cash flow is bad? Of course not. If you're in a well-structured deal with tested operators, stable debt, and conservative assumptions, yes, cash flow can be a beautiful thing. It gives you liquidity, flexibility, optionality. It can fund your life or protect your future. But the moment you start using cash flow as a shortcut to avoid deeper thinking, you've already lost. Cash flow should be a symptom of a healthy investment, not a replacement for due diligence. And that's the shift I want you to make. Stop asking, how soon do I get paid? Start asking, where is the yield actually coming from? What would have to go wrong for it to disappear? What's hiding behind the IRR? Because when you get curious about the mechanics behind the promise, you become more dangerous, more confident, and far less likely to be seduced by a PDF with the bullet points and a 6% pref. So next time someone tells you, this one is great, it cash flows day one, here's what you need to say. Show me the assumptions. Because if you can't test the foundation, you don't know what kind of house you're really walking into. Let me close this section with a personal rule I follow. No cash flow is worth the risk of capital loss. You can recover from missed income. You cannot always recover from a blown principal. And that's the real game. Not how much can I earn from this quarter, but how do I protect the machine that earns me for the next 30 years? If you're long-term thinking, you start treating every distribution not like a reward, but a responsibility, a signal to go deeper, to look closer, to protect your blind side. Because the moment you stop doing that, you're not investing, you're hoping. And hope is not a strategy. Let's keep this going, and in the next part, we'll unpack another piece of dangerous advice. Just hold it long enough and it'll work out. It sounds wise, it sounds Buffettish. But real estate, especially with leverage, that advice can quietly wipe you out. So let's talk about why time isn't always your friend and how to tell when you're playing defense without even realizing it. Let's talk about another idea I keep hearing. Just hold it long enough, real estate always works. Sounds reasonable, sounds like wisdom. It's often said with a smile and a glass of wine. And if you zoom out far enough, decades, generations, yes, and most real estate appreciates over time. But here's what no one tells you. Time doesn't heal poor underwriting. Time doesn't fix broken structures. Time doesn't bail out over leveraged sponsors. And time definitely doesn't wait for your refinance to work if your debt matures next year. So when someone tells you, don't worry, you're just hold it long enough, what they're really saying is, we didn't build this with a margin of safety. We're crossing our fingers and hoping nothing breaks. Hope is not a strategy. Let me show you how this plays out in the real world. A few years ago, we looked at a deal in the Sun Belt, Class A multifamily, huge growth projections, beautiful photos. The sponsor said, we're playing long term. We don't care about short-term noise. We're in this for 10 years. It sounds smart, right? But when we asked about debt, it turned out they were using a 3-year interest-only bridge loan with no rate cap, no hedging, no refinance strategy. And when we modeled a 200 basis point interest rate move, the cash flow turned negative. So we asked, what happens in year 3 if rates are higher and you cannot refinance? And I'll never forget the response. He said, well, that's why we like to play long-term. Real estate always recovers. And that's not a strategy, that's storytelling. Because here's what happens in the real world. Lenders don't care about your 10-year vision. If the debt matures in year 3 and you cannot refinance or sell, you are out. The clock runs out. not because of your asset, but because of your structure. This is the hidden risk most investors miss. They think in terms of assets, but real estate isn't just an asset. It's a contractual timeline. It's a race between your operating performance and your capital stack's expiration dates. So yes, holding long term can work if the deal is built on to survive short-term shocks. But if it's not, time becomes your enemy. Let me break this down simply. Holding long term only works when three things are true. One, you have the right debt structure, fixed, low leverage, or long-term non-recourse. Two, you have a sponsor who can operate through volatility, not just raise money, actually operate. And three, the market itself isn't built on speculative assumptions. It's one, if any one of those is weak, then just hold it isn't a strategy. It's a stall tactic. And here is the danger. This advice tends to show up when deals are already off track. Occupancy slipping? Don't worry, long term will be fine. Rent growth softening? No problem, the area is still appreciating. It's a way to avoid hard conversations, to avoid facing what the numbers are already telling you. And the kind of delay, it's expensive. Now, does that mean you should never invest long term? Of course not. Some of the best wealth building opportunities I've seen come in 7 to 10-year holds, but only when the short term risk is managed well up front. Because here's the truth, time is not a moat, time is a multiplier. If your deal is strong, time compounds your returns. If your deal is fragile, time compounds your risk. And your job as an allocator is to know the difference. Let me give you an example from my own pipeline. We recently reviewed a 5-year preferred equity deal on a stabilized asset in the secondary market. The sponsor framed it as long-term, low-drama cash flow play. And when we looked closer, they were counting on a refinance in year 2 to return capital to investors. And if that didn't happen, Waterfall would put the LPs behind on catch-up distributions. And they'd lose seniority on exit. So we asked, what happens if the refinance market is frozen in year 2? Their answer, we'll just extend. We've got a good relationship with the lender. Translation, we're hoping nothing goes wrong, and we don't really have a plan B. We passed, and a few months later, the same lender pulled back from that market. Refinance terms tightened. Investors got stuck, not because of the asset, but because the structure had no flexibility. That's why I say just hold it is not a strategy. It's a sales strategy. And if you're not careful, it'll lull you into thinking you've made the safe decision, when really you've just signed up for years of quiet anxiety and limited liquidity. So what should you do instead? Start with one question. If this deal has to exit in year 3 instead of year 7, what happens? If the answer is we're fine, great. You might have something worth holding. If the answer is we'll figure it out when we get there, that's not a hold, that's a hazard. And the cycle with debt markets tightening, exit caps expanding, and sponsors getting squeezed, the investors who thrive won't be the ones who believe in the forever. They'll be the ones who underwrite every exit like they might happen in year 2. Because maybe it will. In the next part, we're going to talk about the third piece of advice I hear that's very dangerous and I hear constantly. The idea that passive income is the holy grail. But the truth, what most people call passive is actually blind. And that blind spot is where a lot of wealth quietly gets erased. Let's talk about it. Let's talk about the holy grail. Passive income, the phrase alone has built entire industries. It sells courses, builds followings, fills masterminds. It's the dream that hooks almost every emerging investor. I'll buy a few assets, set it and forget it, live off the yield. Financial freedom, time freedom, geographic freedom. All the magics of a mailbox money. And to be fair, there's a version of that dream that's real. But for most people, the way they chase passive income is anything but passive. And definitely not intelligent. Let me explain. When someone says, I want passive income, what they actually mean is, I don't want to trade time for money anymore. That's fair, I get it. I felt the same way after I exited my company. But here's where things go off the rails. Instead of building a clear, structured, risk-managed portfolio, they start chasing yield. They start buying into marketing, not underwriting. They hand capital to random operators because they like the idea of being hands off. And then what happens? Distribution stops, reports get delayed, that passive asset suddenly feels like active, mentally, emotionally, and sometimes legally. I've seen investors put half their net worth into passive real estate deals that had no protections, no oversight, and no alignment, all because the deck said that they'll earn 10% while they sleep. But passive income doesn't protect you from poor judgment, and it doesn't compensate for the lack of clarity. Because here's the uncomfortable truth: you cannot delegate conviction. And most people chasing passive income are really just outsourcing decisions they don't want to take responsibility for. But family offices, the ones I've studied, worked with, and now build for, they do it differently. They don't look for passive income. They look for repeatable cash flow, backed by strong sponsors in assets they understand with structures they control. That's not passive. That's disciplined, and it works. Let me give you an example. We recently built a portfolio for an entrepreneur who sold his company for low 8 figures. Very smart guy, but he was burnt out, and all he wanted was truly passive income. At first, he was drawn to triple net retail, stable tenants, long-term leases. Seemed easy. But when we unpacked the deals, he realized something. If the anchor tenant leaves, if the lease isn't renewed, if the sponsor overpaid by even 5%, that passive deal becomes a turnaround project. And he didn't want to manage the problems from a laptop in wherever he was. So instead of chasing yield, we helped him focus on something else: predictability. We built him a structured income portfolio, a mix of preferred equity, senior debt, and cash flowing multifamily, but all in deals where we knew who was managing it, how the waterfall worked, and how the downside was protected. We stress tested the whole thing, simulated what happens if rate rises, if exits are delayed, if rents flatten. And you know what he said afterwards? He said, "This is the first time I felt calm with my capital in 5 years." That's the real goal. No hype, no early retirement, no flashy dashboards, just calm. Calm in a new alpha. Calm is the new edge, but calm only happens when your capital is allocated with conviction, not exposure. And that's what most people get wrong about passive income. They think, if I can just buy enough assets, I'll be free. But freedom doesn't come from a number of assets you own. It comes from how well you understand what you own and who's running it. So let me offer you a better framework. Stop asking, how do I make passive income? Start asking, what systems, structures, and sponsors can I trust enough to perform even when I'm not watching? That's the real question. Because once you've solved that, you don't need the chase income. You engineer it. And once you engineer it with clarity, you can get to stop managing money emotionally. You get to stop checking portals like a hawk. You get to stop asking, did I miss something? Because your structure handles that for you. That's what family offices do. They don't aim for high returns. They aim for controlled outcome. And that's the shift I want you to make. You don't need more deals. You need more discipline. You don't need more yield. You need more clarity on what that yield is built on. And you don't need more passive income. You need capital that performs whether you're paying attention or not. Because the system was built to protect you when you're not in the room. That's the kind of wealth that lasts. So let's wrap this up. I'll tell you a story of a deal I almost did, one that checked all the boxes, looked clean, felt smart, sounded smart, but I passed. And it's a good thing I did, because it's now the exact kind of deal I warn people about. Sometimes the best decision you ever make is the one you didn't. Let me tell you about a deal I almost did. It was early on. I had just had that big exit, and I had capital, I had confidence, and I had this hunger to start putting my money to work passively. A friend introduced me to a sponsor, the sponsor track record, slick tech, downtown multifamily, promised 10% cash on cash from year one, 15 to 17% IRR over 5 years. Everything was clean. They said all the right things, like great tax benefits, conservative underwriting, Class A location, you can't lose. And I wanted to believe them. But something in the back of my mind said, slow down, look deeper. So I asked to see their sensitivity analysis. What happens if rent growth slows? What happens if lease up delays? What happens if interest rates spike before they refinance? Their answers, not bad, but vague. And the more I pressed, the more defensive they got. And I started noticing things. Optimistic timelines, leverage pushed to the limit, no real contingency for capital calls, and no real alignment. They were making fees whether the deal performed or not. That's when it hit me. This isn't passive investment. This is high risk, operator dependent, fragile structure, dressed as a mailbox money. And I almost said yes because on paper it made sense, and emotionally I felt like momentum. But I walked away. And a year later, that deal ran into issues, construction delays, cost overruns, the refinance window closed, distribution stops, investors were stuck. Not wiped out, but they were trapped. And I remember thinking, that could have been me. That almost was me. And that's when I decided I'm not allocating capital based on optimism anymore. Not on hope, not on charisma, not on this feels right. From that moment forward, I made a commitment to structure every investment around one question. What happens if nothing goes according to plan? If I can answer that with clarity, I still feel calm. Then maybe it's worth doing. If not, I'd rather sit in cash than chase someone else's fantasy. That's one decision that just saved me from a bad deal. It gave me a North Star, a new way to think, and eventually the foundation of how we underwrite every opportunity at Infinity today. Because good investing isn't about trusting the upside. It's about being honest about the downside and deciding who you want to be when the market turns. There is no shortage of advice in real estate world right now. Podcasts, webinars, reels, courses, everyone has a take. But very few people are accountable for their outcomes. That's what makes this space so dangerous. You can sound smart, you could look credible, and you can still put other people's capital at risk because you never actually had to explain what went wrong. And that's what I want to protect you from. Not from bad returns, but from bad logic, bad assumptions, bad thinking that sounds right, but breaks when reality shows up. We talked about 3 of the most common traps today. First, cash flow is king. It's only true when it's real, risk-adjusted and durable. Otherwise, it's just a mirage. Second, just holding long enough. Only works when your structure gives you time. Most don't. And third, passive income. The goal isn't passive, it's disciplined. It's capital that performs whether you're constant attention or not. If you're watching this, chances are you've already built something meaningful. You're not starting from zero, but you're realizing that the next phase of wealth isn't about effort, it's about allocation. It's about asking better questions about protecting your peace, not just your principal, and learning to say no even when the deal sounds great. So here's what I want you to leave you with. Clarity is your edge, not confidence, not charisma, not deal flow. Clarity. Clarity about who's in control, clarity about how returns are actually created, clarity about what happens when things don't go to plan. Because when you build that kind of clarity, the kind that almost investors never get to, you stop gambling, you start allocating, and then everything changes. Now, this episode helped you see things more clearly. I invite you to keep going. You can revisit this one, you can pause, you can take notes, you can run your next opportunity through the same filters we use at Infinity 9. And if you want more frameworks, more real world thinking, more conversations like this, that's what we're building here. Every week, quietly, disciplined, no hype, just clarity. Because in this market, clarity isn't just your edge, it's your survival strategy. Protect your capital, protect your peace, and keep allocating like it matters, because it does.